global recession incoming? These three charts say yes. What if the next global recession has already begun, and we're just too distracted to notice? While central banks insist everything is under control and the media keeps repeating the phrase soft landing, three critical charts are painting a far more disturbing picture. These aren't speculative opinions or doomsday forecasts, these are cold, hard numbers. And they're all pointing in the same direction, down. In today's episode of Money Minded, we'll break down three warning signals that historically precede every major recession. They're flashing red right now, louder than they did before the dot-com bust. Louder than they did before the 2008 financial crisis, and louder than they did in 2020. Yet, most people are still asleep. You'll see why. The bond market is more scared of the future than ever before. Global shipping is slowing down faster than economists expected. And consumers, the backbone of every modern economy, are starting to buck. Flee under the weight of inflation and debt. We're not here to sell fear. We're here to break through the noise and show you the data the headlines are ignoring. If you care about your job, your portfolio, or your financial future, this is a video you can't afford to miss. So hit that like button, subscribe to Money Minded, and let's dig into the charts that might just be telling us. The recession isn't coming, it's already here. Chapter 1, The Yield Curve Inversion, a 100% recession predictor. Let's start with what's often called the most reliable predictor of recession in modern finance, the yield curve. At its core, the yield curve simply compares interest rates across different U.S. Treasury bonds. In a healthy economy, longer-term bonds, like 10-year notes, have higher yields than short-term bonds, like 2-year notes. Why? Because lending money for longer periods carries more risk, so investors expect more return. But when that flips, when short-term rates are higher than long-term rates, we get what's called an inverted yield curve. And that's exactly what's happening right now. In fact, the current 2-year to 10-year inversion is one of the deepest and longest lasting in history, even worse than what we saw before the 2008 financial crisis. This isn't just a technical anomaly. It's a signal that the bond market, the world's largest and most sophisticated financial market, is betting on an economic slowdown. So why does this matter? Because inverted yield curves crush bank profitability. Banks borrow money short-term and lend it long-term. When the curve inverts, their margins shrink, or even vanish. That means less lending, tighter credit conditions, and a ripple effect that hits businesses and consumers alike. Now here's where it gets really serious. Historically, every single U.S. recession in the past 50 years was preceded by a yield curve inversion. According to the Federal Reserve Bank of New York, the probability of a recession within 12 months of an inversion is over 80%. Some researchers argue it's closer to 100% when the inversion lasts longer than 6 months. We're currently 18 months into a sustained inversion. Still not convinced? Look at what followed previous inversions. In 2000, the yield curve inverted, then came the dot-com crash. In 2006, it inverted again, followed by the 2008 housing crisis. In late 2019, the curve flipped right before the COVID-induced recession of 2020. This is not a theory. It's a historical pattern. And yet, the mainstream narrative today still suggests a soft landing. But if the yield curve could speak, it would be screaming, "Brace for impact." And there's more, the yield curve isn't the only red flag. In the next chapter, we'll shift from finance to the real economy. Because if people aren't buying, shipping slows. And when shipping slows, it's not just a chart, it's a warning that global demand is drying up fast. Stay with us. Chapter 2, Freight volumes are collapsing, the economy's supply chain is choking. If you want to know where the economy is heading, don't just look at Wall Street, follow the freight. Shipping volumes are like a real-time heartbeat of the global economy. When people are buying, goods are moving. Trucks are full, ports are busy, and supply chains are humming. But when demand dries up, freight slows. And right now, it's not just slowing, it's falling off a cliff. Let's start with the US. Trucking industry, the backbone of American commerce. According to the Cass Freight Index, shipment volumes have dropped by over 9% year-over-year. That's one of the sharpest declines since the pandemic lockdowns. And this isn't just a seasonal fluctuation, this is a structural slowdown. Freight companies are feeling the squeeze. Trucking giant Yellow Corporation filed for bankruptcy. Major logistics firms like FedEx and UPS have issued profit warnings and started cutting jobs. Their message is clear. Business activity is weakening, fast. But the problem isn't limited to the United States. In Europe, container port activity has fallen dramatically. German industrial exports are slowing. In China, shipping volumes out of major ports like Shanghai and Shenzhen are also slipping, despite Beijing's stimulus efforts. The Baltic Dry Index, which tracks international shipping rates for raw materials, has declined more than 50% from recent highs. When freight drops across continents, it signals something more than just a local slowdown, it suggests that global demand is retreating. Here's why that matters. Freight doesn't lie. It's not based on forecasts or consumer sentiment. It's real-time evidence of what's actually being bought, shipped, and consumed. It tells you what retailers are expecting, what manufacturers are producing, and whether businesses feel confident about the next quarter. And right now, they don't. Even diesel fuel demand, a key indicator tied directly to trucking and logistics, is declining. Refiners are reducing output. Shipping firms are canceling orders. And supply chains that were once overwhelmed are now underwhelmed. Some might argue, but inflation is down. That should help. Sure, inflation has cooled slightly. But that doesn't necessarily revive demand. In fact, many businesses now face demand destruction when high prices and high interest rates have already crushed consumer buying power, leaving no easy path to recovery. And what comes next in this cycle? Historically, when freight slows significantly, corporate earnings follow. Companies cut inventories. Then they cut spending. And eventually, they cut jobs. The freight sector is often the canary in the coal mine. When it starts to collapse, a broader economic downturn is usually not far behind. Let's look at past patterns. In 2007, freight volumes peaked in Q4, 6 months before the Great Recession began. In 2020, the Cass Freight Index cratered, weeks before stock markets caught up. And now, in 2025, we're seeing eerily similar signals. If you're only watching the stock market, you might think things are stable. But if you zoom out and look at the real economy, it's flashing warning signs. And freight data is the proof. So what do you do with this information? Understand that economic slowdowns don't begin in headlines. They begin in warehouses, loading docks, and cargo terminals. By the time the news media talks about recession, the data has already been screaming for months. And as you'll see in the next chapter, it's not just businesses showing signs of weakness. Consumers, the very engine of modern economies, are starting to run out of steam. Stay with us as we explore the collapse in consumer confidence and why it may be the final domino to fall. Chapter 3: Consumer confidence is collapsing, and that means trouble ahead. We've talked about the bond market. We've talked about global shipping. Now, let's look at the engine that powers over 2/3 of the US economy and a massive chunk of global GDP, the consumer. Because when consumers stop spending, everything else breaks down. Right now, consumer confidence is in a free fall. The University of Michigan's Consumer Sentiment Index, a benchmark gauge of how people feel about the economy, has dropped significantly from its post-COVID recovery highs. In May 2025, it hit its lowest level since 2020, and the expectations for the year ahead are deteriorating fast. Why does this matter? Because consumer sentiment isn't just a feeling. It influences real economic behavior. When people are pessimistic about the future, they delay big purchases, cut back on discretionary spending, and tighten their budgets. That means less revenue for businesses, fewer new jobs, and shrinking GDP. And we're seeing the ripple effects everywhere. Take a look at credit card delinquencies. They're spiking across all age groups. According to the New York Fed, credit card balances have reached record highs, and late payments are rising sharply. Meanwhile, savings rates are near record lows, as people burn through the cash reserves they built up during the pandemic. Even worse? Real wages aren't keeping up. Inflation may be lower than it was in 2022, but it's still eroding purchasing power. The average household is paying more for food, rent, insurance, and basic services, without a corresponding increase in income. And it's not just low-income households feeling the pressure. A growing number of middle-class families are cutting back. Vacations are being postponed. Retailers like Target and Home Depot are reporting weaker than expected earnings. Restaurants and entertainment venues are seeing fewer customers. Even luxury brands are starting to notice a shift in spending behavior. When the average consumer pulls back, companies notice, and they react. That means layoffs, hiring freezes, and reduced capital spending. All of which contribute to a feedback loop that pulls the economy further down. But here's the part most people miss. Consumer weakness often shows up after yield curve inversions and alongside freight slowdowns. In other words, it's the final confirmation that a recession isn't just possible, it's likely. We've seen this exact sequence before. In 2007, consumer sentiment dropped sharply as the housing market cracked. In 2000, the dot-com bubble burst and households reined in spending. In early 2020, spending collapsed before the markets had time to react. And now? We're watching it happen again. Adding fuel to the fire, interest rates remain elevated, making mortgages, car loans, and student debt more expensive. Younger generations, millennials and Gen Z, are being priced out of homeownership, unable to build wealth in the traditional ways. This economic anxiety is not just emotional, it's logical. Consumers see the storm clouds gathering, and they're pulling back accordingly. The problem? Once that pullback reaches critical mass, it feeds into a larger economic contraction. And we may be on the verge of that tipping point right now. So if you're seeing empty storefronts, quiet malls, or fewer cars at restaurants in your city, you're not imagining it. The signs are there. And consumer behavior is changing fast. In the final section of this video, we'll bring it all together. The charts don't lie. The yield curve, the freight volumes, and the consumer sentiment all point to one conclusion: a global recession may not be coming, it may already be underway. Let's connect the dots, next. Conclusion: the recession warning lights are flashing louder than ever. So let's take a step back and connect the dots. The yield curve, one of the most consistent recession indicators in history, is deeply inverted and has stayed that way for over 18 months. Freight volumes, the lifeblood of real-world economic activity, are collapsing across the US, Europe, and Asia. And consumer confidence, the foundation of demand in modern economies, is falling rapidly while debt burdens rise. These aren't random data points. Together, they form a synchronized signal, a system-wide warning, that global economic momentum is fading. It's easy to ignore the warning signs when stock markets are still climbing, headlines are calm, and politicians tell you everything is resilient. But history shows us that recessions don't begin in the markets, they begin in the margins. They begin in credit markets, in shipping containers, in household budgets stretched to the limit. And by the time the headlines finally say we're in a recession, the damage is already done. The truth is, we may not be heading toward a recession. We may already be in one. It just hasn't been officially declared yet. So what does this mean for you? If you're an investor, it's time to reassess risk. If you're a business owner, it may be time to tighten operations. If you're just someone trying to protect your income or savings, now is not the time to get complacent. Recessions create winners and losers, and those who prepare early tend to come out stronger on the other side. Here's what you can do. Stay informed. Ignore the spin, follow the data. Diversify. Don't bet everything on one outcome or one asset class. Build liquidity. In uncertain times, cash is a strategic asset. And most of all, pay attention to what the charts are telling you, even when the news won't. At Money Minded, we're not here to spread fear. We're here to help you see clearly through the fog. Because the more informed you are, the more empowered your decisions become. If you found this breakdown helpful, don't forget to like this video, subscribe to Money Minded, and share it with someone who still thinks everything is fine. Remember, when the signals are this clear, ignoring them is no longer an option.